a new cap on the cost of the vehicle. So $55,000 for an SUV and $80,000 for other vehicles. So I think there's only one Tesla that might qualify for that under that with that price tag. So it's going to be interesting next year.
So basically, if you want to buy a Tesla, maybe wait a year, but buy the Model 3, there's probably going to be Model 3 price inflation. So basically, if you're buying an electronic vehicle this year, you don't want to buy a Tesla, you don't want to buy Toyota, you don't want to buy GM, maybe buy the Audi e-tron or some other vehicle maker that has not exceeded the 200,000 threshold. Is that correct?
That's correct. And also look at the new income thresholds. So more wealthier people next year will not qualify for any credit because of the income caps, which I don't know offhand, but they're substantial. And there are different income caps for whether you're buying a new vehicle or a pre-owned vehicle. So again, you got to check out those income caps. And certainly if you would not qualify next year, you might want to make the move this year.
So the income caps are not on the vehicles this year. They will be on them
Correct.
Next year. So this whole thing is ridiculous. That's why we brought you. So what other things? Solar. If I want to put solar panels on my business, should I wait till next year or should I do it this year?
Well, that's going to be, the solar has not really changed. In fact, they've extended the homeowner solar and made it for longer. And I think the solar is pretty much the same for business.
What about the Trump, the accelerated depreciation? So we have a lot of people in here in the Clubhouse room live. They're Bitcoin miners. They want to get a massive write-off on their Bitcoin mining facilities or their real estate purchases. Doesn't that end January 1, 2023? Or does that end?
It doesn't end, but it starts to phase out. So there's 100% bonus depreciation this year. And starting next year, it reduces to 80% and then 20% reduction each year thereafter. And the point to note is that there was a lot of talk about perhaps extending this particular break, which is very favored by a lot of businesses, but it didn't happen.
Yeah, I love that. We need to bring back this 100% bonus depreciation, but explain it for people who don't realize it, because it's one of the little known pieces of the Trump tax code that is so good for real estate investors, Bitcoin miners, whatever you could be. Explain how it works.
Well, sure. Usually when you buy property, equipment, and realty, you have to write off the cost over a set number of years. And the years are fixed by law. You just can't choose. But under a special rule called bonus depreciation for 2022, if you buy and place in service before the end of the year eligible property, and there's a wide range of what qualifies as eligible. It's not a building itself, but certain things may qualify. And you can write off 100%. Just deduct it like any other kind of regular expense.
Wow. That's fantastic. So how does it work? So I'm going to buy a building for my business. The building's, explain how that works.
Okay, well, the commercial building is going to continue to be depreciated. That has not changed. What's interesting is that savvy real estate people and business people can do what's called cost segregation studies to try to break out certain components and be able to write off certain improvements within a building over
that's what I was referring to. Yeah.
Period.
So the bonus depreciation more affects your copiers, your business equipment.
Generally, yes. It's basically for your equipment, but think about all the businesses that have heavy equipment. I mean, it could be a substantial write-off.
Oh, definitely. It's fantastic. Does the cost segregation go away next year?
No. that's with us. There are new guidelines, and it's not it's not a do-it-yourself activity. And it's only for, with big dollars involved, because the professional fees are going to be steep. But in the right situation, it can really save a lot in
You
tax.
get massive write-offs. And so we're going to take the first break of the hour. We're with J.K. Lasser, small business expert. She's been called the guru of small business taxes by the Wall Street Journal. Barbara Weltman, attorney, author, public speaker, nationally recognized expert. And she's here on Clubhouse, WOR, iHeartRadio app, Spotify, and more. So if you have a question, type your question in the chat box on YouTube or Clubhouse. We'll bring you up. You can ask any small business question for free. It could be on taxes, could be on the new Inflation Reduction Act. And folks, if you call my office at 888-988-JOSH, you'll get Barbara's latest book for free. I'll buy it for you if you schedule and keep your no obligation 7 Ways to Save Taxes review. 888-988-JOSH, 888-988-5674. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback. So we talked a little bit about Inflation Reduction Act. What other things do our listeners need to know about this Inflation Reduction Act?
I think everybody needs to know about the $80 million that's going to the IRS and what that may mean for taxpayers, small business owners, individuals, and large corporations as well. Secretary Yellen 2 days ago. So
wait, it's $80 billion. So there's a lot of 80s to be thrown around. It's $80 billion to
right.
fund the IRS. Anywhere from, machine guns for the IRS agents. I'm just having fun. I don't really, been hearing.
Well, no, it's actually true.
It's true.
That was
Go ahead.
Part
Yeah,
of
let's talk about that.
Yeah. I mean, because they do have a criminal division, so that's not untrue. But for most people, don't get too excited about this. Secretary Treasury Yellen had said that the thrust of the enforcement will not be against people with income under $400,000, but there's really no way to guarantee this. It's kind of like almost an absurd statement, because if somebody's reporting zero income on their return and it's not right, aren't they the ones you want to look at? I mean, it doesn't make any sense. So I think the point is, and this was in
it's really dumb because
report.
they were all going after Trump's tax returns and all that type of stuff. Yeah. But if you have a real estate person, they're worth $500 million in real estate, and they're taking all these massive write-offs. Maybe you want to audit them to make sure they're doing cost segregation properly and bonus depreciation properly and all that stuff. So that seems hogwash. I don't know if anybody can trust whatever she says now. That I think they said, what'd they say? Inflation was transitory. Now that now they're saying we're not going to use these on the regular people. What about what I've been thinking too? Are they beefing up enforcement surrounding crypto and Bitcoin? I mean, you have many people are millionaires and even billionaires due to cryptocurrency. What are they going after these people with this $80 billion?
Well, let me give everybody a heads up that they have they've come up with the draft forms for the 2022 tax return, and they've changed the question on the first page of the 1040 with respect to cryptocurrency and to broaden it to digital assets. So it would also apply to non-fungible tokens, any kind of digital assets. That's one thing. The second thing to keep in mind is that previous recent legislation authorized new reporting on crypto transactions. It doesn't apply until transactions starting in 2023. And so the information returns won't be going out till 2024. But clearly, this is something in the IRS target. The question is that what kind of guidance are we going to have? What kind of rules are we going to have? Right now, there's not much out there, and we really don't know a whole lot.
Ken, one thing we do know for certain is hide your wallet, people. And, you know, I think the little guys are going to get screwed by these 87,000 new IRS agents. I mean, who are they? How are they even going to find these people?
Well, let me just say that for a lot of taxpayers, when we say audit, there's audit and then there's audit. So getting a letter in the mail can be an audit, a correspondence audit. And that letter may say, oh, do you have proof of this? Or you made a math mistake or something very minor. And that is considered an audit. And audits of more modest income people, it's sort of like a computer generated kind of thing. It's not the in your face kind of audit that the word connotes. So it's hard to know exactly what's going to happen with the 87,000 new agents. I think technology is going to play a big role here. I think we'll have to wait and see how they tune that up and get new audit targets. So I think we really don't know is the bottom line. But I think that for most people, it's been my experience that everybody tries to do the right thing. Yeah, there are the exceptions, but most people try to do the right thing. And if you make mistakes, you correct them, and it's not the end of the world.
We're with Barbara Weltman of J.K. Lasser's Small Business Taxes 2022 guide, which will be your free gift if you call us at 888-988-JOSH and schedule your no obligation review. So what are some other things we've got to know about this Inflation Reduction Act? I always love any of these acts do the opposite of what they're trying to achieve. The Affordable Care Act made healthcare less affordable. Inflation Reduction Act really doesn't do anything other than it's an IRS act. So what else do we need to know?
Well, first of all, no one knows if it will bring down inflation. If you look at the so many economists weighed in, and you had so many economists saying it won't do anything, and you had an equal number saying that it would do something, and so much depends not only on the act directly and the additional funding that's going to go into circulation due to new green energy grants and all of that. It's going to depend on kind of like trickle down, like what it's going to mean. With people having jobs, will people be getting more money? Will people be spending more money? And what will that do to inflation?
So IRA, the Inflation Reduction Act, you think it's a good thing, bad thing, and what's your verdict? Or it's mixed?
My verdict is that there are some winners and there's some losers, and that's the unfortunate thing. One of the things, for example, is that they kind of punish small business owners because one of the ways they decided to pay for some of the spending in the measure is to extend the non-corporate loss limitations. They added 2 more years to that. It's kind of an easy thing to do because it's not very visible, but it sort of punishes small business owners that may experience losses for a particular year for whatever reason. And unfortunately, that's not a good thing. But there were some other things that were good. For example, an increased deduction for commercial energy efficient buildings that's going forward. So things will be better for owners and lessees who make certain energy improvements to commercial buildings, and they'll get a better write-off. So again, there are winners, there are losers, and it just kind of depends where you fall on the spectrum.
So yeah, let's break through the commercial building. So if I own a commercial building, do I wait to do stuff this year or next year? What are those benefits?
Well, they're going to be greater write-offs next year for sure. So these things don't get done overnight anyway. And so with respect, and also you have to, as you, I'm sure you always tell your clients, you kind of have to take a multi-year view and see what your tax position is this year, what you project it to be for next year. And so it's not an easy one size fits all kind of answer. It just depends on your situation and where it may make more sense for you.
What about, so we're talking with Barbara Weltman. Stop muting me, Jim. I'll mute myself. So as it relates to, we went over commercial, we went over, you said some losers. What do you mean corporate loss? So you talk about like the loss on your taxes?
A non-corporate loss. So because owners of pass-through entities, of S corporations, partnerships, limited liability companies, sole proprietors, they report their share of profits and losses on their personal returns. And the amount of the losses that they can write off in 1 year is capped under this special provision. And so this is, kind of an unfortunate.
What is it capped at?
Well, it's basically capped at your expenses in excess of your income up to, and then there's a limitation based on income. It's for joint filers, for example, it's $500,000 adjusted for inflation. So I don't recall the exact number for 2022.
So how does that work? You have a bad year. You have a $500,000 loss in 2022. You can
let's say you have a $1 million loss.
Okay.
That could be your share of the loss, and you can only take up to whatever that cap is. And the rest of that will become part of your net operating loss going forward. And going forward, the net operating loss, you can only use it, the carry forwards, to offset 80% of your taxable income going forward. So,
so that can be significant.
Think about it, that you have income, you have to report it all. You have losses, well, they're limited.
Yeah, that really stinks. Who is fighting for the little guy? That's what that one really hurts small business. So we'll be back with more. We're taking our second break of the hour. This is Josh Jelinski, the financial quarterback. If you have a question for Barbara Weltman, author of the J.K. Lasser's Small Business Taxes for 2020, 2021, 2022, she is your guru of small business taxes. If you have a question, type it in the chat box. Make sure you hit subscribe on the YouTube, or subscribe to us on Spotify or Apple Podcasts. If you have a question on Clubhouse, type your question in the chat box or YouTube. We would love to answer any of your tax questions for free. It's a great value-added show today. So call us 888-988-JOSH. We'll be back after these messages. And we're back with Barbara Weltman. So Barbara, what other things do we need to know about?
Well, I think we can talk more about the Inflation Reduction Act, but I think it's brand new. We haven't seen any real great details, unless you want to sit down and read the 755 pages, which I have scanned, but I have to confess I haven't studied it as much as I will be in the next several days. There are many other things going on tax-wise right now that I think people should know about.
Let's talk about them. Let's go right at it.
Yeah, sure. So first of all, people have to kind of finish up with 2021. Some millions of people are on extension now, and I don't know what happened.
Go ahead, you're there. Keep talking.
Okay. Millions of people are on extension, and they have until mid-October to file their return. But if they're owed a refund, they should file as soon as possible to get that money back. And another thing that's sort of hanging over from prior years, as you well know, people during 2020 may have taken COVID-related distributions from their qualified retirement plans, from their IRAs, and they're allowed to put the money back. There's a 3-year limit to doing that. So certainly, if they want to replenish their retirement nest egg, that's something that they need to do. And when they do that, they will have to file one or more amended returns to recoup taxes that they've already paid. So that's another way to get some money back, and while boosting your retirement savings. Other things is one of the things that we're trying to keep an eye on now, that it's sort of baffling to me that it hasn't been enacted, and you probably are well aware of this, Josh, is the pending retirement plan legislation that was passed by the Senate, similar measure passed by the House. They haven't kind of melded those pieces together to get some final act, but it would kind of be like the Secure Act 2.0, and it would enhance retirement savings opportunities for workers, for business owners, and we're keeping an eye on that, and that could still happen this year.
Yeah, I hated Secure Act. I hated Secure Act 1.0. So I can only imagine how much Secure Act 2.0 screws people. We're going to talk more about that. But first, we're going to go to John. John had a question. We'll talk more about the Secure Act. John had a question on digital asset reporting. I think he left, but any more comments on digital asset reporting before we go?
Yeah, digital asset reporting is very challenging because the IRS has decided that digital assets are going to be treated as property, not as currency. So that means that every transaction that you do with digital assets, you have to determine gain or loss. And it depending on the context in which you're using the digital assets, you may have capital gains or losses. You may have ordinary income, ordinary losses. So, for example, some people are getting paid, independent contractors are getting paid in Bitcoin. And if they're getting paid in Bitcoin, they're going to have to figure gain or loss on that. And then they're going to have to factor that in not only to their profits and which they pay income tax, but also their self-employment tax. So that's one wrinkle that's very challenging for businesses that accept payment from customers in digital assets. This is their income, but every transaction has to be accounted for individually. Now, clearly, businesses need to set things up so they can do this properly. Individuals, you got to do it because this is how you have to report it on your tax return.
Small business tax questions. So let's talk about Secure Act 1.0. A lot of people didn't realize what happened with Secure Act 1.0 because then we had COVID, and then they're clueless on Secure Act 2.0. So let's talk first about Secure Act 1.0, then we'll go to 2.0.
Okay. Well, the original act, one of the good things it did was delay required minimum distributions for owners from their IRAs and retirement plans. And that was kind of a good thing because people are staying in the workforce longer and don't really want to tap necessarily into their retirement savings. And one of the other things that it did, and this is so problematic now, I'll go into some detail if you like, but as a general thing, they changed the rules for beneficiaries.
Yeah, go into detail
because
I think people need this fleshed out. Yeah, go ahead.
Yes, okay. So for people who inherit these accounts from someone who died after 2019, they can no longer the general rule was that you could kind of take the distributions over your life expectancy based on IRS tables. Well, they changed that to a 10-year rule saying by the end of 10 years, It's all got to come out. The IRS and there are exceptions, of course, for minor children, for a spouse, for people with disabilities. There are certain exceptions. But for the most part, that's the general rule. Combined with this, the IRS has come out with new life expectancy tables. The life expectancy tables are a good thing because they reflect longer life expectancy, meaning that you have a smaller required minimum distribution because supposedly you're living longer. But the problem is how all these things come together. And then we have proposed regulations on how the 10-year rule works. There's been tremendous pushback on these regulations saying that so much of it doesn't make sense. People don't know what to do. The year is winding down. It applies for 2022, and people have to know, beneficiaries have to know what they're supposed to do before the end of the year. Perhaps we'll have a postponement in these regulations, and that's sort of what a lot of professionals are hoping for, but we have no assurances. And I don't know what to say about it other than it's certainly a challenge, and it's something that people have to monitor. Now, yes, you do have until the end of the year to kind of sort this out, and hopefully we'll have guidance by then.
We're with Barbara Weltman, and we'll take our next break, and we'll pause for 30 seconds while Barbara gets her screen. It's a little fuzzy on the YouTube. Maybe they can. Okay, it works better now. So, folks, give us a call, 888-988-JOSH. I will give you the J.K. Small-Lasser book, most recent edition that Barbara authored, for free when you schedule and keep your no-obligation review at 888-988-JOSH. For the 7 ways to save on taxes review. Also, we're live on Clubhouse, YouTube, so if you have a question, it could be on anything. Secure Act 2.0, crypto taxation, Bitcoin taxation, whatever, we're here for you. 888-988-JOSH, 888-988-JOSH. We'll be back after these messages. And we're back with Barbara Weltman. I'm Josh Jelinski, the financial quarterback. So basically, Secure Act 1.0, so to kind of make it plain English, if you have an IRA and you die, your heirs are screwed. If they died after, what was it, January 1, 2019? Or January 1, 2020?
I think that was the cutoff date.
Something like that.
It was. Yeah,
and a lot of people didn't
that.
realize that. So you could have had the Mitt Romney size IRA, and essentially it was a glorious thing called the stretch IRA because your heirs got to stretch it out over their life expectancy. In a lot of ways, it was like a middle-class trust. Now,
exactly.
Now people will have to hire attorneys to do the sophisticated things that basically the stretch IRA did anyway. You could still do those. You could actually still do stretch IRAs now. They're just not IRAs. They're non-qualified stretch annuities. You could do trusts and distribute the tax over so many years. But it's convoluted now. Used to be simple. You name your kid's beneficiary, boom. And a Republican president, mind you, did that. And I thought the death of the stretch IRA was the biggest screw job of middle class. And they basically said, well, you know what? We're going to extend your RMD from 70 and a half to 72. So everybody's up in arms about that. So now they're going to say, okay, well, you'll get to wait till 75 now on Secure Act 2.0. So explain Secure Act 2.0. But I think the reason why I wanted to talk about Secure Act 1.0 is it affects everybody. If you have a 401k, IRA, 403b, 457, you can no longer just leave your IRA to your kids. Best thing to leave your kids, leave your stock in an outside IRA account. Leave it in a brokerage account. Leave life insurance. Leave already taxed money. But that IRA, you should think about it as like an annuity for your life, the way they've currently redesigned these things, because after 10 years, the whole thing has to be spent. And they've changed the rules. They changed the rules on Roths to some degree, where if you did a Roth, you had tax-free money for as long as you live. You still have that, but now that ends after 10 years, after the death of the second spouse. So Roth's still powerful, but not as powerful as it once was. Any comments on that before we go to Secure Act 2.0?
Well, I think your points are well taken, and it's really unfortunate because I think most people have no clue about this, and it's their heirs who are going to kind of have the wake up call about it, and so most people have no idea about what to do or what the impact is. And for people with substantial accounts, this is something that it's going to cost them, because they're going to have to, if they want to protect their heirs, they're going to have to invest in professional fees to do something about it.
Yeah, I mean,
So
now you got to
think
do
you're absolutely
insurance
right.
and trusts and all these kinds of things. Basically, have the same thing that the IRA would afford you to. And we have a lot of clients, listener friends, they have significant amount in IRAs, and it used to be simple, and now it cannot be simple. So if you just have your money going to your kids on your beneficiary designations, think again, because they got to accelerate the tax. One guy says it's called the dreaded MITE, the massive income tax acceleration bill or something like that, because it forces you to accelerate the spend down of your IRAs. So what's in Secure Act 2.0 that we need to listen?
Well, one of the things that you did mention was that they will, over a significant number of years, raise the starting age for owners of their accounts. So it will raise to 73 and eventually to 75. So that will be a good thing, but it won't happen overnight. Another thing is that the whole thrust of the measure is to make sure that more people have retirement savings. If you look at just the numbers, so many people, I mean, these aren't the people that you're seeing, Josh, but so many people in the workplace don't have sufficient retirement savings. And this is a big concern because we know Social Security doesn't provide a secure financial future. So a lot of the provisions are designed to encourage businesses or in some situations, require businesses to do certain things to ensure that workers get coverage.
Now, that's fantastic. So we're with J.K. Lasser's Barbara Weltman. I know there's a guy who listens to my show faithfully who does something with you, but
he may be listening. He was away, but he might be back by now.
He'll be back. So that's cool. So, but I don't think, again, people don't grasp this. This 75 thing, I don't think it's 75 till what, 2033?
Yeah, it's something well, we don't know dates yet because originally, remember, this was all supposed to happen last year. The provision got passed by the Senate last year, in fact. This is just a re-up of the prior rule. So it's 73 should have happened for this year. Now it's pushed to next year. So who knows if and when they enact this, when the dates will come. But you're right that it's spread out well into the 2030s before we reach age 75.
So we're with Barbara Weltman talking taxes. So what else do we need to know about the Secure Act 2.0? But this is my thing. This is why I think it's a screw job. If they're going to say you have 10 years to pay the tax, I sort of get that. I don't like it. But at least give us something like make the RMDs 75 now, effective immediately. Because it's not that you're getting the government's getting paid 10 years after you die, they get all their money back, plus interest. I also think it is significantly misguided because the stretch IRA was in a way like an annuity for the government. So I think whoever said that that's going to raise revenue, I think it'll raise revenue short term, but not long term because you'll lose the compounding off of those IRAs.
Yeah, it would have just gone on forever for the government to be collecting, and the accounts would have continued to grow and therefore pay out more. The fact is that when you look at the numbers of people that this impacts, it's not tremendous, because a lot of people who inherit these accounts, they take all the money out right away anyway. We're not talking about huge accounts. But for many people, they have been faithfully putting money away year after year for many years. As the stock market has grown, so too has their savings. And so now you're talking about big bucks.
Yeah, it also affects, I was speaking with a dear listener friend. Mother's giving them, $250,000 in, a famous dividend paying stock. So it affects people, and the client goes, you know what, I want to just inherit that and just let it blossom and grow just like my mother did. So it really affects people who are responsible, the good little boy and girl who saved their money. It doesn't affect the people that spend their money. And it's really like a middle class way to pass wealth. So it's a really dumb thing. So what else does the Secure Act 2.0 do that we need to be aware of? Or is that
it enhances what 1.0 did rather for part-timers. So it will be a greater help for people who are long-term part-time employees, to help them with their savings and get covered by 401ks. I think we have to wait and see what ultimately is going to be in the final act, because as I said, there are two different versions floating about, and we don't know.
Yeah, and
that's
they
really
both
not
stink.
the only, that's not the only thing that's floating around. There are there's other unfinished business in Congress.
Well, let's talk about that unfinished business when we take our final break of the hour with Barbara Weltman. What unfinished tax acts do we need to be made aware of? Build Back Better, any of these other things coming back? This is Josh Jelinski, the financial quarterback. And if you want her book, J.K. Lasser, Small Business Taxes, you can go to Barbara's website, bigideasforsmallbusiness.com. You can buy the J.K. Lasser Small Business books on Amazon or wherever books are sold, or you can get it for free if you call me right now and schedule your 7 ways to lower taxes on your portfolio review. 888-988-JOSH, 888-988-5674. We'll be back after these messages. And we're back. Final segment with Barbara Weltman. So if you have a question, now's the time to chime in. Type your question on YouTube, Clubhouse, or more. So Barbara, what is the unfinished business?
Well, as we've experienced almost every year, year after year, there are provisions that have expired, and we don't know if they're going to be extended for next year. We talked earlier about bonus depreciation declining, and there's a great sentiment, as we said, to retain the 100% bonus depreciation. Another new rule that went into effect this year, which has a lot of businesses upset, is a rule that requires an amortization, meaning spreading over a number of years, a minimum of 5 years, R&D costs, research and development costs, rather than in the past being able to elect to write them off in 1 year. And so, again, there's that and other business incentives that I think there's some sentiment in having them enacted. We don't have to worry about Build Back Better, because what was enacted today, what was passed by Congress today, the Inflation Reduction Act, is the smaller version of Build Back Better.
Is there any hope that it can be like? Did it pass the House?
It passed the Senate, and it passed the House.
And who are these people? They're screwing all of us. So, I mean, give me a break. I don't know how this passed. It's basically I guess, what would you say, a toned down Build Back Better?
Yes, it's smaller. It's less less spending,
less
than,
onerous, but still,
but not dramatically less. So it's really something.
yeah. I don't know who likes these bills. I sure as heck don't. I mean, there were some. I guess they got rid of the more onerous pieces of Build Back Better, but still.
What's kind of amazing to me is that they've never addressed certain things that would benefit many, many people. For example, you and I know that there's a limit on capital losses in excess of your capital gains to up to $3,000. That hasn't changed in, I don't know how many years, 25 years, more. Why isn't that provision changed? That would help so many people, especially people who took a bath in the market this year. It's coming back, but some people had substantial losses already. I don't know why that hasn't been brought up to date. Many of the provisions in the tax code are antiquated and don't conform to today's world.
Well, because it would help too many people. The Tesla write-offs help the rich. They help the donors who can afford these cars. I mean, although they have some, that's even dumb, right? Because who can afford these electric cars? So basically, the whole reason certain people bought the electric cars was because they got the write-off. Now, if you make so much money or your car's worth a certain amount, you don't even get it anymore. So it's just, these things are dumb. I actually thought the 7,500 credit, was it 7,500?
Yeah, that was a maximum credit.
I think that was a very good piece of having tax incentives incentivize people to go green. Now, you can debate, is it really green? Because you're going to have the batteries leaching into the soil and the pressure on the grid, and then we're going to have to go nuclear. But, I thought that actually the $7,500 credit's not a bad one. So basically, we built a whole, one of the biggest companies on earth now, Tesla, was pretty much subsidized by the government. So we all made Elon Musk a billionaire. But in one sense, it was a way to have public policy kind of, I guess that's a positive example. IRAs are another where people, it's a middle class tax savings vehicle that has been used to generate more wealth, even though the 401k or the IRA doesn't get much love anymore. I've met more people who have become millionaires due to their 401ks than probably just about anything. So there's some good pieces of tax legislation that ends up incentivizing good things. This just seems like, if I can see right through it, that $80 billion is going for chain analysis on Bitcoin transactions, on cryptocurrency transactions. It's buying, the enforcement, all these things. But I heard a lot of the bill didn't even go to the problems right now the IRS have is being understaffed just with people getting their refunds back. So a lot of the bill didn't even go to that. You want to comment on that?
Well, they're trying to hire and they're trying to work through the backlog. I think the point to be made is certainly that people who are owed refunds, you got to file electronically and you got to ask for direct deposit. And that's one of the ways to assure that you're going to get your refund quickly. There's still paper returns to be processed. People with amended returns, they're waiting to be processed. And the IRS is trying to hire, and they have had the money to do this. But, this isn't an overnight thing. Even with the authorization of the new funding, it's not going to happen overnight. And frankly, a lot of the complaints that I've heard about have to do with technology, that the IRS hasn't brought up their technology to the level that it should be so that they can process returns more efficiently. They can be coded better and processed quicker. And let's see if the money goes
for
there.
that. Some, $2 billion and, where's the money going? that's the thing. It's going to like some software engineer to develop something that they'll probably never use, No, but I've heard that they're underfunded in terms of software solutions. So we're with Barbara Weltman. So what other, as we kind of close out the interview, what other tax tips do you have for our listeners to save on their taxes right now? Top 3 tips we didn't talk about. Doesn't have to be related to Inflation Reduction Act or Secure
Well, one
Act.
of the things that we have not talked about in years has to do with the home sale exclusion, which is the opportunity to have tax-free capital gains on the sale of your residence. But with so many people selling their homes this past year, it's sort of on the front burner again. And the point that all homeowners should take from this is because of rising prices and the fact that the home sale exclusion is not adjusted annually for inflation, the best way to minimize any gain that you have to report on a sale is to keep track of all capital improvements that you make to your home. So keep those receipts, keep a record of anything that you're doing. You're putting on a new roof, you're adding an addition. Those kinds of capital improvements will add to the basis of your home and effectively reduce your gain that you have to pay tax on.
So keep all the receipts. Your landscaper, your pool company, all of those things.
Well, it's not your daily repairs and painting and that kind of thing. It has to be capital improvements. So it could be I think new carpeting and things that are
no, but if you use a pool,
house,
let's say you buy a pool heater, that would count, right?
You put in a swimming pool, you betcha, but not the weekly maintenance.
So not the chemicals.
No.
What about painting on the coping?
No, the painting is not going to do it. It's
what
just
about,
not going to do it.
So what about?
But you put in central air conditioning
There you go.
or something like that. That's
flooring, windows.
You put in a security system.
What about landscaping? Depends. Not cutting your grass. Not cutting your grass.
Your regular maintenance, no, but
Yeah, not regular maintenance, but those, redoing the shrubs or planting rose bushes, stuff like that might count, right? Okay, cool. Well, this was a lot of fun. If any of our listeners have any more questions, you can type in your question. We have a final few minutes for any questions on taxes. If you have questions on your taxes and any, want to give us a final tip, Barbara?
Sure. There's still time to adjust. We have 2 more estimated tax payments to go for 2022, and you can still adjust your withholding for 2022. So don't overpay and then have to wait for a refund when you file your return next year. So make sure that you adjust it so that you are paying enough to avoid penalties, but that you don't overpay. So look out at your income year to date. Look at your personal situation. Has anything changed? Do you have a new baby? Have you adopted a child? Things that can impact what your tax bill will be, and maybe make adjustments because that can put money in your pocket now.
Wonderful. Barbara Weltman, J.K. Lasser, Small Business Tax Book 2022. That'll be your free gift when you schedule and keep your no obligation review at 888-988-JOSH. I want to thank you all for joining us. Make sure you follow me, follow the club, The Financial Quarterback. Subscribe to us on Spotify, YouTube, iHeartRadio, and more. And check out Barbara's website, which is bigideasforsmallbusiness.com. Right, Barbara? Is that your website?
That's it.
And folks, give us a call, 888-988-JOSH. You'll get the free book when you schedule your 7 ways to save on your taxes. And that's another tip, consider your pensions, consider maxing out your 401k. Many people don't even know about a solo 401k, solo Roth, defined benefit pension plan, cash balance pension plan. a lot of people are not taking advantage of very easy deductions to build their retirement. So give us a call if you need help, 888-988-JOSH. I want to thank you all for joining us, and have a great day. So thanks all for joining us on Clubhouse, YouTube, and thank you, Barbara.
Thank you.